Hello, welcome back. So in today's video, I'll be covering a few things. We'll be covering the stocks that I'm waiting for, international market stocks, as well as some questions that you guys have left me in the comment section below. So let's talk about high quality stocks that are falling first. So Visa and Mastercard have fallen by quite a fair bit over the past few days because of this Senate bill. So this Senate bill actually came out and said that your stable coins, they'll be pegged 1-to-1 against the US dollar, and that will be written in law soon. So here are some of the stablecoin arguments that I've seen online. So the first one is that it will lead to lower cost for your merchants, hence they are incentivized to push the stablecoins. Consumers might be forced to use the stablecoins as well to shop because of lack of alternatives. So this is what a comment actually said. It says, if one day they said use your Walmart app and pay you get discount, we don't accept credit anymore, it's easier than it seems. The Visa and Mastercard stronghold only really holds where people can choose where to spend. In the case of Walmart, there is no major alternative for this giant. Will you shop at Cold Storage just because they don't allow you to pay by card at fair price? Especially when they're giving you discounts on their app, and given Cold Storage might be further away as well. So here are some of the counter arguments to those. So the first one is that your merchant-specific stablecoins, they're extremely inconvenient. So imagine shopping at 50 different shops and then having to basically fill up your stablecoin wallet for all these different 50 merchants. That will be extremely inconvenient. And then the second argument is that your networks can offer a universal solution for your stablecoin. So Visa and Mastercard have the biggest scale to implement all these stablecoins as well. So the next counter argument is that while the Republicans are accepting this one right now, if we see a party change in the US itself, then this could lead to a lot less adoption of crypto. And then the last argument is that the networks, they hold a significant leverage as well. So imagine Walmart's having to launch their stablecoins and having a 10% adoption rate. Visa and Mastercard holding the other 90% will be able to pressurize Walmart as well as Amazon to basically pay them more money or to reduce the adoption rate on the other side as well. So imagine going to a store and then not having Visa and Mastercard payments there. That would be terrible for the consumer. And I expect that to continue for a very long time. So for Visa and Mastercard, they're coming out with stablecoins as well. So Mastercard, they unveiled end-to-end capabilities to power stablecoin transactions. So imagine just one card for all your different stablecoins. That is what Visa and Mastercard can do. And they're the only company that can do that because they have the scale and the network effects for that. Whereas for all your different other individual merchants, they don't have the ability to do so simply because they're not as wide scale as Visa and Mastercard. So for Visa and Mastercard, Mastercard is down around 8% over the past 5 days, currently trading at a 37 times earnings. So the global payment volumes have been increasing by around 8 to 9% every single year for the past 10 years, and Visa and Mastercard have been able to increase their take rate on that as well. And for Visa and Mastercard, they've been able to grow revenues as well as earnings at upwards of 12% over the past 10-20 years or so. And for Mastercard, I expect that to continue as well. So that's why I have an EPS growth rate of around 15%. So assuming a 12 to 13% earnings growth and a 2% buyback for Mastercard, that will give you around a 15% growth. So assuming a 30 times earnings for this stock, in 2022, the lowest valuation that it reached was around 28 times earnings, which was its lowest valuation over the past 10 years. So assuming a 30 times earnings for Mastercard, this stock will give you around a 12% CAGR if you buy it at around $495 a share. And that's why I'll be adding to Mastercard as well. At $495 a share, I view it as fair value. I don't view it as extremely undervalued. But for a quality business like Mastercard, I think this price is decent. So for Visa, my entry price is around $295 a share. So assuming a 28 times earnings for Visa, Visa is a bit more mature than Mastercard. So the valuation is slightly lower as well because of the lower growth rate. And assuming a 13% EPS growth, this company will give you around a 12% CAGR at $295 a share. So I'm aiming towards $295 a share. Hopefully Visa can get there. And hopefully Mastercard gets to around $500 a share as well. That'll be when I'll be adding to my positions in those two companies. Next stock that I'll be talking about is MSCI. So MSCI year to date is down around 9%. Currently it's trading at a 37 times earnings. So for MSCI, this company is incredibly stable. So the top portion is the revenue growth chart, and there's barely any dent over here. The only time it dropped was in the 2008 crisis, and all the way since the 2008 crisis, the revenue has never had a negative year. In fact, in 2020 as well, the company was still able to grow despite the COVID pandemic, as well as in 2018 when we saw the tariffs and all the economic data as well. The company was still able to grow revenue back then. And the company is also a buyback machine, so this is the shares outstanding, and they've been steadily buying back shares every single time, applying leverage whenever necessary. So for example, during the COVID pandemic when the rates were around 0%, MSCI actually got in a lot of debt to buy back the shares. That was amazing for the shareholders itself. And so the capital allocation on top of the stability of the company is just incredible for this one. So for MSCI, this is the mode of the business. So the mode of the business is basically the ability to bring all the clients into their ecosystem itself. So one of the most powerful advantages that MSCI has is how deeply integrated its products are in the workflow of its clients. Its indexes and analytics support everything from portfolio construction and asset allocation to performance attribution and reporting. This level of integration creates substantial switching costs. Replacing MSCI means overhauling internal system, rewriting client mandates, and redoing regulatory disclosures. For most firms, the disruption far outweighs the potential cost savings. So apart from that, the CEO actually also came out and said that 88% of our subscription run rate comes from clients who use multiple MSCI products. So for MSCI, it's similar to S&P Global with their credit ratings. So for S&P Global in their credit rating portion, what they do is they will embed that credit rating portion into their data business as well, so that S&P Global is more deeply entrenched into the client's entire work system. So this is similar to what MSCI does as well. So for MSCI, they have the indexes as well as the analytic portion. And when you combine those two together, it is impossible for you to leave the ecosystem itself. So for MSCI, besides that, it is impossible for your asset managers to basically switch off MSCI because of the brand name of MSCI itself. So MSCI is a widely known brand, and an additional aspect is the potential consequence for individual funds having benchmarked against the same index for years and decades and then switching. This introduces complexity in backtracking historical performance and may send an unintended signal to investors, raising questions about consistency or strategy. So MSCI's brand name itself is so powerful that all your asset managers, they simply cannot switch. It's similar to what S&P Global does with your S&P 500, as well as the Russell by LSE. So another critical factor is MSCI's scale and breadth. With over 240,000 indexes across geographies, asset classes, factors, and themes, it can support nearly any mandate. So they have multiple different indexes, and they're basically the worldwide index. So outside of the US itself, MSCI is actually the biggest index provider. So I'm sure you guys have heard of MSCI World Index, MSCI China Index, MSCI Emerging Market Index, and so on. So as people shift from active investing to passive investing, as more people start to dollar cost average and buy all these different indexes, you will see a lot more growth for MSCI as well, which is why I'm bullish on this stock as well as S&P Global. So for MSCI, this is my valuation for the stock. So for the first 5 years, I've actually put a 12% free cash flow growth. And then for the next 5 years, I'll put it at around 10% free cash flow growth. This company has historically grown between 17 and 20%. So I think 12% is quite reasonable for this company. They grow revenues at between 11 and 12%. So 12% free cash flow growth is definitely possible as well. And if you were to add the operating leverage as well, they could easily go above 12%. So besides volume growth in your asset managers, MSCI also has pricing power. So every single year, they will increase prices by 3 to 4%. It's a contractual agreement that they have with all these different asset managers, the clients that use their products. So MSCI, on top of earning incremental revenue over time from the volume increases, they are also able to increase their prices, which means that their profit will grow a lot faster than the revenue itself. So 12% is definitely doable for MSCI. And assuming a 4% terminal growth rate, this company has a fair value of around $537 a share. So for MSCI, it is currently around fair value. So I'm waiting for this one to drop a bit more before I start adding to my position. I hold a small position in MSCI, but I'm looking to add to this one. It is a high quality compounding machine that will survive any sort of economic downturn. So I'm confident in adding into this one. Next category of stocks are your defensive companies. So McDonald's as well as Canadian National Railway. So these two companies, they're not exciting by any means. But these companies are predictable, high-quality businesses that will just trickle along over the next 10 years, 20 years or so. So McDonald's is actually flat this year. It's currently trading at a 25 times earnings, and it's trading around fair value also. McDonald's has a substantial portion of their business in the franchise portion, which is incredibly high margin. So McDonald's actually has a lot higher margin than a lot of your different tech companies. So the operating margin itself is around 50% for McDonald's. It's quite amazing that a fast food company is able to achieve such high margins. So for McDonald's, I view it as a stable company that will just trickle along. And if I can catch it at the right price, it will give me market-beating returns along with the dividends as well. So the other company is Canadian National Railway. So Canadian National Railway is an oligopolistic stock. So this stock is trading at a 19 times earning and currently is flat year to date. So if you didn't know, Warren Buffett owns a railway company as well. He owns BNSF. So for railway companies, they have incredibly high barriers to entry simply because it costs billions and billions of dollars for you to build out all these rails. And besides that, it is almost impossible for a competitor to come in and steal share as well. So for Canadian National Railway, they almost have a natural monopoly in the geography. For this company as well, it is a stable, predictable business that will grow revenues at around 7%, grow earnings at around 8% or so. And combine that with the dividend that the company gives out as well, this company will give you around a 10% return. This company will give you a stable 10% return over time. So these two companies are incredibly predictable. I'm waiting for them to drop, and I'll be monitoring these ones as well. Next portion, I'll be talking about your international stock markets. So the US market itself is extremely overvalued, so it's currently trading at a 24 times earnings, whereas companies like Japan, Hong Kong, China, they're trading at below 20 times earnings. So Japan is trading at 15 times earnings, Hong Kong is trading at 14 times earnings, and China itself is actually trading at 10 times of earnings. So there are multiple different opportunities that are outside of the US itself. And this is the first stock that I'll be talking about, which is Alibaba. So Alibaba year to date is currently up around 33%. It's currently trading at a 15 times earnings. So for Alibaba, the growth story is simply just the consumer recovery. So if you're monitoring the retail sales data in China itself, the retail sales data have been actually increasing over the past few months, and they've been recovering since the housing crisis in China. So apart from that, Alibaba is also the greatest AI player in China. So they hold the greatest market share in your cloud computing space. And this company is one that I'm looking at. The other company that I'm looking at as well is in Singapore. So this is Singapore Stock Exchange, SGX. So this company is incredibly monopolistic in Singapore because there's no other company that is able to basically replace them. And for this company, if you have to look at the metrics itself, the metrics are simply incredible. So operating margins of upwards of 50%, net margins are incredibly high as well, ROIC. Every metric is amazing for this company. And if I'm able to catch this at a good price, I think this company will provide alpha in a bull market. For SGX, there are risks accompanied with this stock as well. So when we see a bear market, when we see a downturn in the market itself, like in 2022, then SGX will be hurt the most as well. So for this company, it is a toll gate business. It's a high quality one, and this is one that I'm monitoring as well. Last portion, I'll be talking about some questions that you guys have left me in the comment section below. So the first comment, it says, not all boats are made equal. Terry Smith compares WD-40, a company unable to reinvest, to Coca-Cola, a company with ample opportunities for reinvestment. Over time, Coca-Cola compounded more while WD-40 not as much. Despite having better metrics, there wasn't a formula to capture an ability to compound. So I agree with this one, there's no magic formula for you to identify a compounding machine. But with regards to his first sentence there, which is the ability to reinvest, I think it is incredibly important for a company to be able to reinvest its earnings. So for example, a company like Apple, the ROIC is incredible, the metrics are incredible as well. The company has upwards of 50% ROIC, upwards of 100% of ROE, but the problem with the business is the reinvestment rate is way too low. So they can't reinvest their earnings to grow the company even more, and the only way for them to return the cash is to return cash to shareholders. And that is not what you want for your companies. You want your companies to be able to reinvest its earnings into the company and grow its ROIC over time as well. So there's another metric that you can look at as well, which is ROIC, which is your return on incremental invested capital. So it's basically the change in your returns divided by your change in your working capital. So if a company is able to increase its invested capital and achieve incremental returns, then that is amazing for the company. So your expected growth rate for a company is your ROIC times your growth. So for Apple, the ROIC times your growth is actually less than 5%, and that's why you're seeing Apple not being able to grow earnings by upwards of 10% or so. So the best combination is when you can find companies with high ROIC along with high reinvestment rate. Those companies are the one that you should be owning, and those companies will give you alpha above the markets over time. And that is what you're seeing with your hyperscalers today, Amazon, Microsoft, as well as Google. They have high reinvestment rate along with high ROIC. Next comment over here, it says, hey Guan, saw your recent video on the value of Tollroad stocks, and I found this airport, ASR, and this Tollroad company, FER. What do you think? So Ferrovial is actually a company that Chris Hohn owns. It's basically a construction company, and they operate in a BOT model. So a BOT model is basically build, operate, transfer. So what they do is they will fund the toll roads and the bridges itself. So they operate it under an agreement for 50, 60 years or so, collecting incremental recurring revenue over time. And then after the 50, 60 years, then they'll transfer it back to the government itself. So for these companies, for your toll road companies, for literal toll gate companies, these companies are incredibly high quality, they're incredibly predictable as well, because it is recurring revenue and because they're able to increase prices above levels of inflation as well. So for these two companies, ASR as well as Ferrovial, I think these two companies are high quality companies. I hope you guys have found this one useful and invest safe.